Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. Each month, I dive deep into a new investment opportunity, but today we're switching things up with a Watchlist Battle. In this new format, quality companies go head-to-head for a potential spot in my watchlist or portfolio. Our first matchup features 3 financial services heavyweights that earn strong marks on my 33-question research checklist and are all contenders to complement MSCI in my portfolio. So, who are they? First up, Standard & Poor's Global, SPGI. They are a powerhouse in financial data, credit ratings, and indexing. Next up, FactSet, ticker symbol FDS. This is the institutional data specialist, and it's used by asset managers worldwide. And last but not least, Moody's, ticker symbol MCO. They are the credit rating king. So we'll do this through a 5-round battle plus a bonus round at the end. Before we get started, let's first discuss why I'm bullish on the industry. All right, so there are 4 main reasons why I'm bullish on the financial services industry. First, financial data is now a necessity. Second, the rise of passive investing. Third, regulatory and risk management needs. And fourth, high margin recurring revenue businesses. We'll now go through each one individually. For financial data as a necessity, the financial data, indexing, and credit rating industries are the backbone of global finance, benefiting from long-term structural growth. According to McKinsey, the financial information market is projected to grow at a CAGR of approximately 8 to 10% through 2030. And the global financial analytics market is expected to reach 50 billion plus by 2028, according to Grand View Research. This benefits companies like SPGI, MCO, and FDS, among many others. Second, there is the rise of passive investing. Index-based investing, which I've included as ETFs and mutual funds, continues to surge, with passive strategies now managing over 15 trillion globally, according to Morningstar in 2024. This shift in particular benefits SPGI because it's the only one of the 3 that has exposure to index revenues. There's also regulatory and risk management needs. Market complexity is driving demand for credit ratings and financial research. The BIS and SEC continue to expand reporting requirements, boosting reliance on these services. Fourth, high margin recurring revenue businesses. All 3 of these companies boast operating margins of 30 to 50% plus, benefit from pricing power, high switching cost, and long-term contracts. They all also generate at least 55% of revenue from recurring sources, and these are attributes that I really like to see in a potential investment and company in my portfolio. Before we dive into the rounds, here's how scoring works. For each question within a round, I award 3 points to the winner, 2 to second place, and 1 to third. The scores are tallied up to determine who takes each round. Now, let's get started with round 1, business model. A strong business model means predictable cash flows, durable moats, and clear growth drivers. I scored each company across 7 key areas: business mix, geographical diversification, end markets and customer base, how they generate revenue, what percentage of that revenue is recurring, their pricing power, and finally, cyclicality. Let's walk through the highlights. The first section, segments and business mix. SPGI's market intelligence brings in the revenue at 33% of total versus ratings at 31% of total, but ratings drives profitability at 62% of fiscal 24 operating margin versus 19% for market intelligence. MCO's revenue is fairly equally split the last few years between ratings and analytics. Ratings is between 49 and 53%, and analytics is between 47 and 52%, but ratings drives operating profit at 65 to 70%. For FDS, I just have one segment in business mix, which is financial and market data subscriptions at 100%. I give SPGI the win here with a 3 rating because I really like their diversified segments of market intelligence and ratings, and I didn't even mention their indexes business, which is their 3rd largest segment. For geographical diversification, MCO gets the win as technically the most geographically diversified business, with 53% of revenue from the US versus 47% non-US revenue over the last 3 years. SPGI gets the 2 with 60% US revenue and 40% non-US revenue over the last 3 years. And FDS gets a 1 with the most US revenue at 64% versus 36% non-US revenue for the last 3 years. The third section, in markets and customer base, I give SPGI the win and the 3 rating due to the fact that their in-market and customer base is the most broad, which includes investment firms, corporations, governments, insurance companies, and commodity traders. MCO gets the 2 rating, and they are mostly tied to credit markets, so their customer base includes banks, insurers, investors, corporations, and governments. FDS gets the 1 rating as their in-market and customer base is mostly on the buy side, which includes asset managers, hedge funds, investment banks, and wealth managers. For the fourth section, revenue generation, FDS gets the first win with a 3 rating, as nearly 100% of revenue is subscription-based access to its technology platforms. SPGI gets the 2 rating, and as of 2024, most of their revenue is through subscriptions at 52%, followed by transactional revenue from ratings at 21%. MCO gets the 1, as they are reliant on transaction-based fees from credit ratings, but they do have high recurring revenue from analytics. Speaking of recurring revenue, that is the 5th section of the business model comparison, and FDS gets the win again with nearly 100%, I think it was 99% in their 10K of revenue recurring. MCO actually gets the 2nd rating with 62 to 69% of their revenue recurring from 2022 to 2024, and this is across all segments. And surprisingly, SPGI actually gets the 1 rating here with 55 to 60% of revenue recurring from 2022 to 2024. And what I've included here is their subscription revenue plus their recurring variable revenue. The 6th and second to last section is pricing power, and here SPGI gets the win. I have their pricing power rated as strong, with S&P indices deeply embedded in financial markets and ratings a necessity for debt issuance. I think they have strong moats and pricing power across 2 different markets. MCO is just a tail behind on pricing power, I think, and I gave them a 2 with strong pricing power again, as they are a duopoly with S&P for credit ratings, which I just mentioned how necessary they are for debt issuance. And I gave FDS a 1 or the lowest on pricing power with moderate. I do see that they have strong customer retention, but I do think they face a lot of competition from Bloomberg and Capital IQ that ultimately limits their pricing power. Lastly, cyclicality. I give FDS the 3 in the win here, as they are less cyclical due to the subscription-based model. SPGI gets the 2, as ratings revenue can be cyclical, but indices are less so. MCO gets the 1 because they are highly dependent on credit issuance cycles. So overall, looking at the scorecard, SPGI gets a 16, MCO gets a 13, and FDS gets a 13. That means the winner is SPGI in round 1. Now let's move on to round 2, financial quality. A great business needs great financials. I ran a comparison across 15 metrics covering revenue consistency, free cash flow, margins, returns on capital, and debt. Quick note on methodology first. I do use median for ROIC and stability metrics since they're more sensitive to outliers, and averages for margins and free cash flow conversion, which tend to be more stable year over year. Okay, the first metric is quality score from my checklist, and FDS gets the win here, or 3 rating, with a 70% quality score. MCO is number 2 with a 67% quality score, and SPGI trails both with a 61% quality score. The second metric is the 20-year average revenue stability from investorsgrow.com. FDS again gets the win with a 0.93 revenue stability score, and the closer to 1.0, the better. MCO comes in second again with a 0.89 revenue stability score, and SPGI trails again with a 0.87 revenue stability score. The third metric is a 10-year median revenue stability score, and on this metric, SPGI is the winner with a 0.95 revenue stability score, while MCO and FDS both get 2 points here with a 0.94 revenue stability score. The fourth metric is 10-year revenue CAGR, and SPGI wins and gets the 3 rating with a 10.9% 10-year revenue CAGR. FDS comes in second with a 9.1% revenue CAGR, and MCO is third with a 7.8% CAGR. The fifth metric is 20-year average free cash flow stability, and MCO gets its first win with a 0.81 stability score, and FDS comes in number 2 with a 0.79 stability score, while SPGI only gets 1 point here with a 0.74 stability score. The sixth metric is 10-year median free cash flow stability, and FDS gets the win here with a 0.83 stability score versus SPGI at 0.77 and MCO at 0.75. Like revenue, I then like to look at a 10-year free cash flow per share CAGR, and here SPGI wins at 15.6% versus 12% for MCO and 10.7% for FDS. The eighth metric is 10-year average free cash flow conversion. MCO gets the win here at 123%. This compares to FDS at 114% and SPGI right at 100%. The ninth metric is 10-year average gross margin. MCO gets its second in a row with a 71.9% average gross margin over the last 10 years. SPGI comes right behind it in second with a 69.7% average gross margin, and FDS trails with a 53.9% average gross margin. The 10th metric is 10-year average SBC adjusted free cash flow margin. They all score very high here, but SPGI wins at 28.8%, MCO is 2 at 27%, and FDS is 3 at 24.3%. The 11th metric is 10-year median combined ROIC, which is just the average of stock analysis and QuickFS. SPGI wins here at 27.2%. FDS comes in second at 22.1%, and MCO comes in third at 20.6%. The 12th metric is net cash or debt as of the latest quarter, and here FDS wins with only $1.4 billion in net debt versus MCO's $4.9 billion and SPGI's $10.4 billion. The 13th metric is debt to equity as of the latest quarter. And for this metric, the lower the ratio, the better. SPGI wins with a 0.32 ratio versus 0.81 for FDS and a rather high 2.12 for MCO. The 14th metric, debt to free cash flow, and this is at the latest quarter, trailing 12 months. SPGI wins again with a 2.16 debt to free cash flow ratio versus FDS with a 2.95 and MCO with a 3.14. Generally, anything below 3 is acceptable depending on the industry, and the lower the better. The last and 15th metric is interest coverage as of the latest year. And once again, SPGI takes home the win with a 18.8 ratio versus 10.7 for FDS and 8.5 for Moody's. They all do meet my minimum of 5, but the higher the better, and SPGI wins. So overall, SPGI has 33 points, FDS has 31 points, and MCO has 27 points. So far, SPGI is making a strong case to join MSCI in my portfolio. Let's keep going though to round 3, future growth. Which company is best positioned to expand its top line, bottom line, and free cash flow over the next 5 years? For this round, I scored each company across 4 key metrics: forecasted 5-year revenue CAGR, forecasted 5-year EBITDA CAGR, forecasted 5-year EPS CAGR, and forecasted 5-year free cash flow CAGR. First up, revenue growth. Moody's takes the top spot with a projected 5.9% CAGR, followed by FactSet at 5.7%, and S&P Global just behind at 5.6%. So MCO gets 3 points, FDS gets 2, and SPGI 1. On EBITDA growth, it's SPGI leading at 5.5%, with both Moody's and FactSet tied at 5%. SPGI earns 3 points here, while MCO and FDS each get 2. For EPS growth, SPGI absolutely dominates with a 14.9% CAGR forecasted over the next 5 years, which is significantly ahead of MCO at 11.3% and FDS at 10.3%. SPGI takes 3 points again, MCO 2, and FDS 1. Then we finish with free cash flow. FDS leads here with an 8.5% forecasted growth rate, while SPGI comes in second at 6.9%. And Moody's trails slightly at 6.3%. That's 3 for FDS, 2 for SPGI, and 1 for MCO. Now for the final score for round 3, SPGI wins with 9 points, and MCO and FDS both tie for second with 8 points. SPGI holds on for another tight win. It's the third round in a row. Let's see if they can continue the winning streak as we move on to round 4, management and ownership structure. We've made it to round 4 of our Watchlist Battles showdown between SPGI, MCO, and FDS. This round is all about management quality, leadership stability, and how effectively these companies allocate their capital. Starting with CEO tenure, SPGI has a very short 0.4 years, which gives them a score of 1. MCO has 4.3 years, which gives them a 2. And FDS has the longest CEO tenure at 9.8 years, which gives them a 3. Winner here, FDS. Next, we look at CEO approval rating on Glassdoor, which is 86% for SPGI, and they get a 2. 85% for MCO, they get a 1. And 88% for FDS, so they get a 3. Winner, FDS. There's then a likelihood to recommend rating that I look at on Glassdoor. This time, SPGI gets the win with an 85% likelihood to recommend. MCO has a lower 74%, and FDS comes in at second with 82%. Winner, SPGI. Moving on to CEO total compensation versus the market, I get this off simply Wall Street. SPGI and FDS both come in under the 14.4 million market benchmark at 7.6 million, so they get a 3, while MCO's CEO compensation is 17 million, which exceeds the market median, and they get a 1. Winner, tie between SPGI and FDS. Looking at insider ownership, SPGI and MCO both have minimal ownership at 0.10% and 0.14% respectively. So SPGI gets a 1, MCO gets a 2, and FDS stands out here with a 1.1% insider ownership, which is still relatively low, but they do get the 3 points, and they're the winner here. In terms of institutional ownership, SPGI has 87.2%, MCO leads with 92.1%, and FDS is right behind at 91.2%, so winner, MCO. Looking at 10-year median capital returns efficiency, SPGI allocates 95% of free cash flow to buybacks and dividends, which is actually lower than my 100% benchmark, but the highest among all 3 companies here. MCO allocates 80% and FDS allocates 82%. So the winner here, the lowest, is MCO. I then like to evaluate management on a 10-year median free cash flow payout ratio. SPGI was the winner here with a low 24%, while MCO is second at a 24.7%, and FDS is the highest at 25.6%. So the winner is SPGI. I did want to note, though, that all these companies have very impressive free cash flow payout ratios. Usually my benchmark is 50%, so they all score very well here. There's 2 more metrics I like to look at for this section. The first is a 10-year median stock-based compensation intensity, which is SBC divided by operating cash flow. SPGI's SBC intensity is 4.6% versus MCO's of 8.4%, and FDS with the highest at 8.8%. So the winner here is SPGI with the lowest SBC intensity. Lastly, acquisition intensity. I like to look at this also on a 10-year median basis, and it's just acquisitions divided by operating cash flow. SPGI wins again as it's the lowest at 6.8% versus MCO at 8.7% and FDS at 7.2%. After tallying the scores, MCO ends up with 18 points, SPGI has 21 points, and FDS takes the top position for the first time with 22 points. So the winner overall in round 4 is FDS. Their long CEO tenure, high approval ratings, and higher insider ownership gave them the edge this round. Time to wrap it up with everyone's favorite round, valuation. Here we're going to look at a blend of absolute and relative metrics, including DCF estimates, free cash flow yields, and key multiples like EV to EBIT and PE. Before we get started, it should be noted that all data used for this section was as of the week of April 7th, 2025. We'll start with the discounted cash flow. Using a 9% discount rate, a 2.5% perpetual growth rate, and 5 projection years, FDS is the least overvalued at 27.3%, followed by SPGI at 29.6%, and MCO at 34.7%. Winner, FDS. Next up is the reverse DCF, which backs into the implied free cash flow per share growth rate. Using trailing 12-month free cash flow per share, a 9% discount rate, and a 15 price to free cash flow multiple, SPGI requires the lowest growth assumption at 9.2%, MCO comes in at 9.5%, and FDS is the most aggressive at 10.7%. Winner, SPGI. On to free cash flow yield. SPGI leads again at a 3.85% trailing 12-month free cash flow yield, while both MCO and FDS trail at 3.33%. Since they tied, they both did get a 2. So the winner here is SPGI. Now looking at forward free cash flow yield, the story stays the same as SPGI again comes out on top with a 3.99% forward free cash flow yield. FDS follows with a 3.82% forward free cash flow yield, and MCO lags behind at a 3.32% forward free cash flow yield. Winner, SPGI. Now for EV to EBIT, which gives a sense of the price tag that we're paying for core operations. FDS is the most attractively priced at 24.2, SPGI sits at 26.3, and MCO is the most expensive at 28.3. So the winner here is FDS. The trend continues with forward EV to EBIT, where FDS again leads with a 19.9, SPGI follows at 20.6, and MCO sits high at 25.7. Winner, FDS. Looking at the PE ratio, FDS is significantly cheaper at 28.8, MCO is at 35.4, and SPGI is the most expensive at 35.5. Winner, FDS. Lastly, for forward PE, FDS again has the lowest multiple at 23.5, SPGI is next at 26.3, and MCO rounds out the group at 29.2. The winner again is FDS. After tallying everything up, FDS scores 20 points, SPGI ends with 18, and MCO brings up the rear with 11. The winner of round 5 is FDS. Their valuation metrics consistently show a discount versus the other two, especially when using multiples and DCF. The yields valuation metrics do lean towards SPGI, and MCO appears the most overvalued. Next up, the bonus round, best fit with MSCI. Since I'm looking for the best complementary stock to pair with MSCI, I wanted to zoom out and assess strategic fit. MSCI dominates in global indexing, factor investing, and ESG analytics. So which of these 3 names best complements this type of business? I'll approach this from 2 angles. 1, correlation, and 2, strategic alignment. First, correlation data. From December 2007 to March 2025, Portfolio Visualizer shows FDS with the lowest long-term correlation to MSCI at 0.49, followed closely by MCO at 0.51 and SPGI at 0.52. So for pure diversification, FDS edges out the rest, but all are in a similar range. Post-COVID, so 2020 and onward, those correlations do tighten. And interestingly enough, SPGI now has the weakest correlation at 0.66, just ahead of FDS at 0.67 and MCO at 0.72. The key takeaway here, perhaps? Well, MCO and SPGI did remain highly correlated in both periods, above 0.90 recently and 0.83 pre-COVID, so holding both may be redundant. Now let's look at strategy, and this is where MCO really stands out. MSCI operates in the world of forward-looking asset location across indices, factors, and ESG. MCO, by contrast, is a leader in credit ratings, anchoring fixed income markets and corporate bond issuance. Together, they form a strong barbell pairing. Equity allocation meets credit assessment. SPGI, while a great business, overlaps more directly with MSCI in areas like index licensing. That does limit the strategic diversification, though combining them would create a powerhouse in global indices and credit, an appealing angle if you're leaning into scale. FDS, despite catering to institutional investors like MSCI, plays more narrowly in portfolio analytics and client-level reporting. It's a great niche player, but lacks the strategic heft to truly complement MSCI's global footprint. All things considered, MCO wins this bonus round. The correlation gap between the three is minimal, but MCO's exposure to the debt side of capital markets makes it the most complementary pure-play pairing in my opinion. After 5 rounds and a bonus round, here's how it shook out. SPGI was the winner of 3 rounds. In my opinion, it's the best all-around business with strong fundamentals and a surprisingly good handle on its debt. MCO comes out as the number 2, and they were the winner of the bonus round, offering the best strategic complement to MSCI with their credit size exposure. However, they did score worse than SPGI and FDS in all of the other battle rounds, so they weren't number 1 for me. In third was FDS. They were the winner of 2 rounds, and I believe they're a high-quality niche subscription business. And while they do have the lowest long-term correlation to MSCI, I don't believe that they're the strongest strategic fit. It's worth calling out just how tight the scoring was across every round. These are all exceptional businesses with durable moats, strong cash flow, and consistent execution. There really wasn't a bad choice here, just different flavors of quality depending on what you're optimizing. So what did I do? I initiated a half position in SPGI on April 7th after a short period of price compression. And I'm eyeing a full position if it dips to the long-term moving average around $413. And that wraps up today's episode of Stock Spotlight. I hope you found the watchlist battle between S&P Global, Moody's, and FactSet both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at Invest091. Join me next when we'll dive into Manhattan Associates, ticker symbol MANH. Until then, keep your investments smart.